Now that you're out of the market, what are what are you looking for? What are your buying signals to re-enter the market?
All right, so let's just start with that's kind of a radical conversation. Now that you're out of the market, we this is not something you would want to do very often, in my opinion. You kind of want to stay in there, especially from that kind of the top to the negative 20%. The recovery times are too fast. Even if you got out, you probably get back in at a higher point. All those type of things. You get past that 20%, it does start to get scary, and the recovery times are a lot longer. So then it might make some sense to get defensive. So keep in mind that this is not something that is normal, but this is not a normal situation. We have a pandemic creating problems in China, for example. We have a war in Ukraine, which is creating some inflationary pressures, and we've got inflation that is really high. This is my 36th year in the business, and the last pandemic was in 1918, so this particular data set is pretty incredible. I mean, the things that are happening right now, and especially with this really high inflation. So you get out. Well, we got out. So far, it's worked. Okay, great. Matter of fact, the S&P 500, when we first started getting out, is about 10 or 11% higher than it is now. So that looks spectacular. And then our inverse is about 3.8%. Higher than where we are now. So that still looks good. But then you have to get back in. So how do you get back in? How do you kind of try to capture some of that profit and those types of things? And so that's what the clients have been asking, and I appreciate that. So I put together a slide, and I'll show you kind of what I'm looking at here. There's a lot of density on this slide, but what I'm showing you here is the downturn in 2008. And so one of the things we're doing right now is modeling the downturn in 2008, because if you line up this downturn kind of day by day with the downturn that happened in 2008, they're very, very similar. And the thing to keep in mind is that, the stock market is a representation of human emotion. And so although things may be different, you might have a pandemic instead, and we didn't have that in 2008 and all these things, human emotion hasn't changed since 2008 enough to make a huge difference. So we're modeling our sell and our buy signals around this particular downturn because we are actually tracing this downturn as we speak. Might change, right? But as we speak, so far this year, we've traced this downturn. Where you see the ups there, we had the same ups in the number of days in March and July, for example. We had the same low. It's amazing how much we've traced this kind of on a day-by-day basis. So what we're looking for here is some signals for when we find a bottom. And there's some signals that aren't on this chart. What the Federal Reserve is saying or doing. Do they start to at least raise rates at 0.5% instead of 0.75%? The big thing that's usually out there is this scenario for most of these bear markets where there's some inflationary environment. The bottom has come when the Fed actually started lowering rates. So, maybe that happens next year, and that's a good point. So we'll see how that goes. The yield curve we look at, right? And we look at the leading economic indicators. All of these things are part of that kind of what I call kind of that fundamental analysis of the overall market. And there's a lot more. But when you get into this scenario, looking at the price movement and what's happening in the price is one of the better ways to go, in my opinion. And so you're going to get a couple situations. Number one is you're going to get these extreme stretches. And so there's a green line across here, and that's what's called the relative strength index. And that's on a customized basis for each one of the securities we're looking at. This is SPY, the S&P 500 ETF from State Street. And so we customize that time period and this is 26. So it's 26-day time period for that particular security. Maybe it's 22, maybe it's 16, whatever it is. And when it gets to an extreme stretch, we want to start nibbling back in. And I don't believe in fully getting out all at once, which we didn't. We did piece by piece by piece. I don't believe in getting fully back in either, piece by piece by piece, depending on different signals. Because if you do wholehearted, you're basically saying, I know what's going to happen. And you don't. Nobody does. And so you do those little pieces and you wait and see what happens and you just keep going in that direction. So the stretch is one area we look for, and there's a couple of arrows in there that show where those stretches are. And they weren't the perfect buyback point, but they were certainly better than the top. And then we use a set of Bollinger Bands, which are customized for this particular security for this time frame. We look for buys and sells out of that. We use a moving average crossover. So, again, optimized for that security. And so when that, crosses over one direction, that would be a sell signal. When it crosses over the other direction, that's a buy signal. And for example, we're using a 1260 crossover right now on SPY, exponential moving average, and because that's tested out extremely well, and it's actually worked fairly well for us right now in this market also. So I feel good about that. Moving averages can be kind of late, especially in the buyback period. So that's why you want to have these other pieces. And then one of the other things that's a little hard to see, but there's some little pink dots and then some green dots. They kind of blend together, almost look like a line here. But that's an ATR trailing stop. That's actually very, very interesting. There's a red wiggly line underneath there. That's the ADX, which shows the trend. And then the thing that's right over my shoulder here is called the Fisher transform. And that's actually a very early indicator. But what it does is it shows the cycles. And it's really fascinating piece. So these are some of the pieces we look at on these charts to kind of determine, when do we get out, which has worked out pretty well so far, in this particular, last month anyway. And then, when do you get back in? So we have these different signals. We'll be nibbling back in when we get those and such too. So anyway, that's the answer to that. When do you buy back in? Because, we've been telling the clients, hey, we got out and we're inverse and it's working. And that's their first question. Okay, how, we have signals to get back in. Because that's the best question you can ask because, I think we're almost up 4% on our inverse position that we bought last Thursday, but that doesn't really matter unless you can capture it. Yeah, you buy back in at a higher point, then you might as well just stayed in there, right? So that's where these signals are really important and kind of tracking what's happening there as far as that goes. So we'll see how it plays out.